Hey everyone, welcome back. Today we're talking about the people and institutions behind price moves. Retail traders, market makers, big banks, hedge funds, and hedgers. Why do they trade and how do their motivations push prices around? If you've ever wondered who's really on the other side of your trades, stick around. This will clear things up in plain English. Knowing who's trading and why helps you understand typical behaviors in the market. Just like in a sports game, knowing each player's role helps you predict plays. In markets, different players have different goals and resources. Once you see their patterns, you can read price moves more wisely. Think, when you placed your last demo trade, who do you imagine on the other side? A big bank? Another retail trader? Keep that question in mind as we go through each participant. Retail traders are individual people like you and me, trading from home or via our brokers. We often have smaller accounts, follow public info, and trade in our spare time. Retail traders are individuals trading with their own personal funds, often juggling trading alongside jobs or studies. Their main drive is to grow their capital and learn how markets work. Many begin with curiosity or the hope of extra income, sometimes influenced by social media buzz or friends' stories of big wins. Early on, experimentation and education are also big motivators. They want to test strategies, see charts move in real time, and feel part of the market action. Because retail traders work with smaller accounts and rely on publicly available information, they often react to obvious chart patterns or news headlines. For example, when price breaks a clear support or resistance level, many retail traders may hurriedly enter or exit. Emotional swings, fear when price drops, or greed during rallies can lead to impulsive decisions. Retail stops frequently cluster around round numbers or recent swing points, since those levels feel natural or obvious. Without advanced order flow tools, retailers may miss subtle context and sometimes chase moves rather than waiting patiently. Individually, a single retail order is small, but collectively, retail flow creates identifiable clusters of orders in the market. Market makers and larger participants notice where these clusters lie, when many stops sit below a certain level, for instance. Occasionally, price may dip into that cluster to trigger stops, a liquidity grab, allowing bigger players to fill larger orders at better prices. Thus, retail behavior indirectly shapes short-term price patterns. Because retail orders accumulate around common levels, those zones can act as magnets for price before a reversal or continuation. In less liquid markets or outside peak hours, retail flow can have a more pronounced effect, causing choppier moves. Market makers are firms or desks whose business is to ensure there's always someone willing to buy or sell an asset. They profit by capturing the bid-ask spread, the small difference between the price at which they buy and the price at which they sell. Their underlying goal is not to hold large directional bets, but to facilitate continuous trading and earn many small profits. They also seek to keep their inventory balanced. If they accumulate too much of an asset, they manage that risk by adjusting quotes or hedging in other markets. A market maker continuously posts buy, bid, and sell, ask, prices. When order flow tilts one side, say many buyers arrive, they might raise their ask to manage inventory and risk. In normal conditions, they provide tight spreads and smooth execution. But during sudden volatility or news shocks, they may widen spreads or temporarily withdraw to protect against large adverse moves. They use sophisticated risk management systems to hedge exposures automatically. Their quoting behavior changes dynamically. If they detect heavy buying, they might adjust quotes upward, anticipating further demand, or to discourage too large inventory buildup. Market makers set the visible prices at which traders transact. When they widen spreads or shift quotes, it directly affects the cost and feasibility of trades for everyone else. In rapid moves, their repricing can magnify slippage. A trader expecting to buy at a certain level may get a worse price if quotes move quickly. By balancing inventory, they also influence short-term price oscillations. For example, if they need to shed excess holdings, they might lower their bid, nudging price downward. Overall, market makers underpin market liquidity. Their behavior often determines how smoothly price moves during normal times and how tumultuously it behaves during spikes in activity. Banks and large institutions trade for a variety of reasons. They execute client orders, manage proprietary trading desks seeking profit, and adjust their balance sheet risks, for example, by hedging against interest rate changes. They may hold portfolios requiring periodic rebalancing or respond to macroeconomic developments. These entities pursue both service, fulfilling client needs, and profit through proprietary or arbitrage strategies, with multi-billion-dollar flows at stake. When large institutions need to execute sizable orders, they avoid dumping all at once to prevent dramatic price shifts. Instead, they slice orders into smaller pieces, deploying algorithms like VWAP or TWAP to spread execution over time and across venues. They monitor macro data releases closely. In major news events, their systems can react within milliseconds. Their access to deep research and order flow analytics means they often anticipate or detect emerging trends before retail. Because their trades are large, they pay keen attention to liquidity. They may wait for certain sessions or conditions when liquidity is deeper or overlapping market hours to minimize market impact. Large orders, even when sliced, alter supply-demand balance. Gradual buying over hours can create a subtle uptrend, while heavy selling may weigh on price persistently. During key announcements, their rapid reactions amplify volatility. If many institutions exit positions simultaneously, price can swing sharply. Their execution algorithms themselves can produce recognizable patterns, steady buying pressure or cumulative selling, that observant traders can sometimes spot. Furthermore, when institutions step in to provide liquidity in quieter hours, they can stabilize price, but conversely, if they withdraw during stress, liquidity dries up and price gaps or spikes become more likely. Hedge funds and proprietary trading firms operate with the goal of generating returns above benchmarks. They employ diverse strategies, trend following, statistical arbitrage, event-driven trades, or quantitative models. Driven by performance targets and often using leverage, they seek opportunities where they believe returns outweigh risks. Their motivation is profit, but within structures that demand disciplined risk management to protect capital and satisfy stakeholders. These professionals rely on advanced models, data analysis, and sometimes high-frequency systems. When their models signal entry, they can deploy significant capital swiftly. If multiple funds use similar signals, positions become crowded, and coordinated actions can push price strongly in one direction until the trade becomes overextended. They also use derivatives, options, futures, to express views or hedge exposures. Risk controls mean that if losses mount, they may deleverage or exit positions quickly, potentially accelerating price moves. Their behavior can be both trend amplifying, when many join a move, and reversal inducing, when many unwind simultaneously. Coordinated or model-driven trades from hedge funds can fuel momentum. If dozens of funds detect the same pattern, their combined buying or selling moves price noticeably. Conversely, crowded trades can lead to sharp reversals when participants rush to exit at once, causing spikes or crashes. Arbitrage desks help align related markets, for instance, keeping index futures and underlying stocks in sync. So their activity creates cross-market effects. During periods of stress, forced deleveraging by funds can lead to rapid price swings. Thus, hedge fund behavior often underlies pronounced moves and can create both extended trends and sudden reversals. Hedgers are real-world participants with underlying exposure to commodities, currencies, or other assets. Examples include farmers protecting against a price drop at harvest, airlines locking in fuel costs, or exporters hedging currency fluctuations. Their core aim is not speculative profit, but reducing uncertainty. By locking in prices via futures or forwards, they ensure more predictable revenues or costs tied to their core business operations. Hedgers typically enter offsetting positions in derivatives well ahead of need, following seasonal or contractual schedules. Their trades are purposeful. A farmer knows roughly when harvest arrives and will hedge expected production. An importer forecasts foreign currency payments and arranges hedges. They pay transaction costs or margin fees as the price for transferring risk. Unlike speculators, they are not looking to time short-term swings, but to secure a known. Hedgers are real-world participants with underlying exposure to commodities, currencies, or other assets. Examples include farmers protecting against a price drop at harvest, airlines locking in fuel costs, or exporters hedging currency fluctuations. Their core aim is not speculative profit, but reducing uncertainty. By locking in prices via futures or forwards, they ensure more predictable revenues or costs tied to their core business operations. Hedgers typically enter offsetting positions in derivatives well ahead of need, following seasonal or contractual schedules. Their trades are purposeful. A farmer knows roughly when harvest arrives and will hedge expected production. An importer forecasts foreign currency payments and arranges hedges. They pay transaction costs or margin fees as the price for transferring risk. Unlike speculators, they're not looking to time short-term swings, but to secure a known financial outcome. Their activity may be concentrated at certain times, often planned, and less reactive to intraday noise. Hedgers add essential liquidity, especially in commodity and currency markets. Their consistent, business-driven flows help balance speculative activity. For instance, if many producers hedge by selling futures, it can exert downward pressure. But since it reflects genuine supply-side risk management, it also creates opportunities for speculators or institutions to take the opposite side. Seasonal hedging cycles can influence recurring price patterns. For example, certain agricultural prices may trend in predictable windows as producers hedge or unwind positions. Because hedgers trade for operational reasons, they act as a stabilizing force over longer horizons, even if their concentrated entries occasionally cause short-term bumps. All these participants coexist in one ecosystem, each pursuing different goals. Retail traders chase visible signals and may cluster orders around obvious levels. Market makers supply continuous liquidity, but adjust quotes when big flows or volatility emerge. Banks and institutions inject large, algorithmically sliced orders tied to client needs or proprietary bets. Hedge funds deploy model-driven or event-driven strategies that can amplify trends or trigger reversals. Hedgers enter for business purposes, adding steady liquidity and shaping seasonal cycles. When price approaches zones laden with retail stops, institutions might push into them to gather liquidity. Market makers widen spreads, and hedge funds may join if models detect momentum. Recognizing these interacting motivations helps explain why price sometimes spikes into a level before reversing, why trends can persist or abruptly change, and why certain times, major news releases or overlap of trading sessions, see heightened moves. Though we never know exact intentions behind each order, understanding these typical behaviors offers a framework for interpreting price action more insightfully. That's our deep dive into market participants and their motivations. I hope this sheds light on who might be on the other side of your trades and why price behaves as it does. If you enjoyed this, hit like, subscribe, and ring the bell for the next video. Thanks for watching, and see you soon.